Yes, hey there, folks. Yes, this is Patrick Zielbauer from Infinity Futures, giving you just touching base here with everybody one more time. All right, folks, this is Patrick Zielbauer from Infinity Futures. Welcome. It's 3:28 Central Time on Thursday, August 3rd. We are going to start in 2 minutes with Jonathan from Active Day Trader. Appreciate everybody coming to the event a couple minutes early. Lots of good questions already. We'll answer a couple more here as we get started. For those of you just joining us here, I have a crude oil dome here on the screen. I'm going to close that for now, just for the moment, and leave the charts up here. And in about 1 minute, we'll go through some risk stuff. I'll introduce Jonathan, and then I'll kind of be hanging out in the background answering some questions. I'm sure there'll be a few of them at least. Please feel free to fire those through, and we'll do some Q&A at the end and probably be finished around 4:30 Central Time in about an hour. Yep, thanks everybody for coming. I really, really appreciate it. This is a presentation. We did something with Jonathan, our first one back in May. So it's been a few months, but we're excited to have him back, and we'll talk about the whole setup here in a few minutes, or just in a minute. All right, so I'm going to bring up the risk page briefly, and let's go through some risk information and take some questions related to this if they come through. Trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So, folks, only fund a futures account with risk capital. That means money that you can afford to risk without lengthening your retirement horizon or affecting your ability to maintain your lifestyle. Okay, futures do involve leverage, especially if you use day trade margin, then you really are using a lot of leverage. So if you're not sure what that means or what the implications are, please don't hesitate to talk to your representative in our office here. Everybody here has got one, even if you don't know who it is. You can either just send an email to trade@infinityfutures.com or just reply back to any of the email you get from us, and that will get you to the right person. So risk is not something we sugarcoat here at Infinity. We're happy to talk about it objectively. As I mentioned, if you came in a little bit earlier, a lot of our clients come from other trading backgrounds like stocks or options where leverage may be less prevalent. And as a result, we have grown quite comfortable in explaining this properly to people. So please don't hesitate to talk to us if you have questions about risk, okay? Now, to move on, Jonathan Rose, Active Day Trader. We did our first event with Jonathan in May, and we got a really good response out of it. And prior to that, we had been, sort of in discussions about how we could work together and the type of trading he's doing and how our clients could benefit from the education he's providing and so forth. And we have gotten a lot of really good response over the last 3 months since we did the last webinar, hence we're doing another one. The idea of relative value style trading is something that Infinity really has not gotten that far into over the last couple of years. Jonathan's going to talk a lot about this. It's extremely interesting, and Jonathan does a really good job of taking a concept that is probably one of the weirdest and most opaque concepts in buzzwords in trading in general, the yield curve, and is able to explain what it is and how these pieces fit together in a way that I really just haven't heard anybody else explain. So if you're like a regular person like me and who's not a mathematician who just wants to understand, then listen carefully to this presentation because Jonathan does a really good job explaining it and showing you some real world applications. We plan to record the event. We'll have it up on YouTube within a day or so, so please feel free to review it. And one thing I will mention as well is that, and Jonathan will touch on this as well, is that we do here at Infinity, we do offer true spread margin for exchange recognized spread. This is a big deal for us. It's a big deal for people who are interested in this type of trading. I'll let Jonathan sort of fill in the details about what that implies and what that means to you as a regular self-directed trader. But that is something we definitely do offer. And we have a great charting setup here that can handle things like butterfly spreads and regular spreads. So we've made lots of chart files. This one was made on for a smaller screen, so I know it looks really small. But we've made lots of these pre-made spread files here. So if you're interested in this type of trading and you want to follow along maybe with what Jonathan is doing, feel free to request access to our trial. It's good for 30 days. It's got live data. It's totally free. It doesn't obligate you to anything at all. And we'll give you all these files so you can start practicing with them and just getting, to know, how to read them and how to understand them. And you use that in conjunction with what Jonathan is teaching, and hopefully you can get on the right path. So please do feel free to request that. Again, there's no obligation to us in any way. You don't have to open the account first or pay us any money. It's just a real-time practice environment for you to use. Okay, so please feel free to do that. Without further ado, Jonathan, I want to thank you for planning this presentation. I know you spent a lot of time on it. I appreciate you taking time out of your day. I know you're a busy guy. So thank you again for coming to the event and doing this with us. And go ahead and take it away here. I'll make you the presenter.
So hey everybody, it's Jonathan and Patrick. Thank you very much. What a really nice introduction. I appreciate that. Hey Taya, I'm guessing that you can hear me and see me okay? Oh, fantastic. So yeah, what I found, guys, it's definitely my approach to trading is very different than most people are used to, and it's kind of interesting. I started active day trader at the end of 2015. And what I noticed was the style of trading that my clients were using was very different than what I've been used to. So I think we're both kind of learning from one another. Throughout the presentation, I'm going to leave the questions up. I'll get into the questions as long as they're kind of not breaking the rhythm of the presentation. I think if there's anything kind of brokerage related, Patrick will be on there, and I'm sure throwing some answers out that way. But when we're done, I will stay on for as long as you guys need to make sure we get through all those questions, okay? Peter, are you having some sound issues? I think you might be the only one, so I would suggest signing out and signing back in if you're having sound issues, but I'm not sure anybody else is.
I think it sounds actually okay from here. There may be a little bit of echo, but I don't. It sounds normal to me.
Let me just put the microphone under something that might help. Okay, so let's go on. I think we're okay with sound. So
yeah, go ahead.
Fantastic. So I'm going to lay this out right from the start. When Patrick said risk is not something we sugarcoat, I completely agree with that. I think that it's really dangerous, all the information that comes across many of our emails that talk about nonsensical returns or how something is so easy or whatnot. Trading is not easy. We have to put the work in. But like anything, if you do the work, you can get rewarded after that. So what I'm going to show you today, a unique approach to trading bond futures. We're not going to guess on direction. We're not going to hope for a move. We're not going to hope the market moves in our favor. And what Patrick said, we're going to talk about relative value. And I'll get into that in more detail. I'll tell you exactly what that is. So just like I said, it's not easy. It does need to be learned, just like your profession. If you sell insurance, I'm not going to go add value to your business in a week. It might take 6 months, it might take 12 months, it might take 18 months, but we do have to learn. And for whatever reason, people think trading, there's just some, magical way to figure out how to do it. And then a week later, you can start making money. It's not like that. So I absolutely agree. Risk is not something to sugarcoat at all. I'm a huge proponent of paper trading, learning, putting in the work. Don't dig yourself in a hole in any kind of new approach until you can prove that you can get returns. Paper trade. Paper trade, paper trade, paper trade. If you don't like paper trade, you got to get over that. You got to paper trade, prove it to yourself. Those are the the edge that retail traders could take advantage of. You can learn, for free without risking money in the market. Really appreciate everybody coming today. I appreciate Infinity Futures for inviting me. I have a great relationship with Patrick. And the reason why I'm on here, it's not random. We've been talking with one another. I actually reached out to Patrick because the way that Infinity handles spread margin, they handle it correctly. What I'm used to, at least, what professionals are used to. There are many others of these firms that you could trade futures, but they don't give you the benefit of spread margin. And that's what Infinity does. So when I reached out to Patrick, because my style is mostly relative value and trading like products, correlated products, there's a massive, massive benefit to trading on Infinity. For example, and we'll go through a ton of examples, but one spread, just buying one 30-year and selling one ultra, if you're using a thinkorswim platform, that's $10,000 of margin. If you're using Infinity, that's, I'm estimating, $1,500 to $1,800 of margin, because the exchange recognizes the relationship between those two products, and Infinity Futures passes on that benefit to the end user. So that's why I'm here. That's why it makes so much sense for us to kind of come together and work together. This trade may seem unique. It may seem different. But if you do think that, it's only because you've never been exposed to it. Okay? I personally believe this is the 100% correct way to trade bonds. I personally feel like it's the only way that I would be risking money in the fixed income market. And I'll show you more to that. But if you're just looking at the yield curve or the 10-year, the 30-year in isolation, without looking at the other components of the yield curve, hopefully by the end of this presentation, you might look at that in a different way. This is going to seem unique. This is exactly how the Mercantile Exchange tells you how to trade these products. Right here in front of you, is anybody familiar with this besides my clients who are on here? Because this is directly from the Chicago Mercantile Exchange. And what they do is they share the treasury spreads. They share the ratios that you should be trading treasuries. So this is, if you go on the Chicago Mercantile Exchange website, this is how they teach how to trade these products. And they have all these goofy names, the TUF and the TUB and the TOB and the FIGHT and the FOB and the NOB and the BOB. It sounds like a Dr. Seuss book, but they're real. So I just want to put this up there. For one, I'm not hiding anything. This isn't something where I want to tell you all about the trade and say, the only way to learn how to do it is to go through me. This is directly from the Mercantile. If you just go on Google and search CME ICS spreads, you can find this exact spreadsheet. And what we're going to talk about is how to trade these different relationships. Okay? This trade works for those who are willing to commit to learn. Okay? For those who like to really figure things out, for those who like to put puzzles together, I think you'll find this trade is really fun and has a whole bunch of potential. So I'll give you a little background. Before I do, just so I can get a feel of the room, who here trades bonds? And if you put what bond do you most like, what do you trade? Is it, 2-year, 5-year, 10-year, 30-year? Do you trade spreads? Maybe you trade TLT if you're more into the ETFs, but just give me a good idea. I'm going to go through my background a little bit, and then I'm going to get into the answers, just so, share that with the rest of the room. Grew up in New Jersey, moved out to Chicago once I graduated university in '97. I spent my first 5 years trading on the floor of the Chicago Mercantile Exchange. And then after that, I joined a bond futures firm. I was the 6th employee. We grew it to over 200 employees, sold to a hedge fund in 2010. Done nothing but trade my entire career. At the end of 2015, my style of trade gives me a lot of free time, a lot of flexibility. That's when I started active day trader. So just going through some of the answers, see a lot of 10-year and 30-year. A lot of ZB, jet trades, options, 10-year, 30-year TLT. Okay, a lot of 30-year, a lot of TLT, 10-year, 30-year. STIRs, short-term interest rates, nice. 5, 10s, and 30s, STU, ZB mainly, ZN. Okay, cool. So I think by going through this, I think it's going to open up your mind as far as if you trade 10-year or if you trade 30-year and haven't traded the difference. What we really want to work at is if we're selling a futures contract or if we're buying a futures contract, we want to make sure that we're in the right contract. Bruce is saying I lost sound. Did I lose sound?
No, the sound is fine.
Thanks, Patrick. Thanks, guys. Thank you. Thank you. So the reason I love this trade is a few reasons. For me, I find it very consistent, but I also find it logical, okay? Because we're trying to fit things together. Now, this trade does not rely on technicals, which is going to be very different than a lot of my clients' approach. Also, again, most aren't aware of this, but you can't trade bonds like any other futures contract. I think that's where people make a big mistake. Bonds are a very, very specific type of trade, but we're going to have edge because we're relying on real value. We're not just trying to flip a coin or speculate, play for breakouts or head and shoulders or just rely on technicals alone. What we are relying on is relative value between two instruments. Again, started my career, this is me back in the 5-year in the NASDAQ futures contract. That's where I started my career. I started my career trading NASDAQ, and it was around the time that this rectangle is around the market. Extremely, extremely volatile. That's between 97 and 02. It was an easy trade. That is an easy trade. Now, it sounds silly, but it really was an easy trade. But that market went straight up and straight down. When it went straight down and volatility got real low, that's when the trade became really, really difficult. And so what I did, it was back in 03, I was having trouble trading NASDAQ, so it was time to switch. And that's when the Fed in 03 just started raising interest rates. I expected volatility to come to that market, so I was really interested in learning how to trade bonds, and that's when I joined this bond firm. In 03, I joined a bond firm just when the Fed was starting to raise rates. From 03 to 06, the Fed raised rates from 1% to 5.25%. Right after the Fed did that, they lowered rates from 5.25% straight down to 1/4. Okay, we're aware of the volatility that was around that time. What I found throughout my career, it's really important to go where the action is. And the NASDAQ in 97 to 03, it was really volatile. There was great action. Action, in my opinion, gives us edge. The NASDAQ died down. Traders who stayed in there ended up having a very difficult time. If you're able to move, if you're able to get in front of it, follow the action, that's when, at least in my experience, you can really find some great edge. So that's when I traded fixed income professionally, and now back at it because the Fed's moving again. During this time, I was trading so many fixed income contracts. For those of you guys who have never seen me, this is me right here. The Merc was trying to fly me around all to their best events. Down at Myrtle Beach, playing golf with the LPGA pros, and this is Tiki Barber over here at Baltusrol Country Club. While we were trading bonds, this was the movement. And these are really, they really start to trend once the Fed moves, because the Fed is pretty much telling us which way they're going. Now, of course, entry points are important, managing money is important, but we have a good idea when the Fed wants to raise rates, there's going to be downward pressure on individual bonds. It's just how it is. So I thought about the 3 secrets to the bond trade, and this is what I came up with. For one, bonds are a puzzle. And so many trade just the 30-year or just the 10-year. That just doesn't make sense to me. What we need to do when we trade bonds is we need to be in the right bond. So I have students who learn this trade and they don't look back. They learn this trade, and they only trade bonds, and they smack themselves on the head because they feel like they were careless when they risked money by only trading bonds in isolation, only trading the 30-year, only trading the 10-year. Okay? Second secret is it's just really important to be in the right bond. If you're shorting a future, if you're buying a future, it's really important to make sure that you buy the cheapest future on the yield curve. If you're selling, you want to value them together, and you want to sell the most expensive bond on the yield curve. And then finally, once learned, at least in my opinion, it's just a very, very consistent, cool trade to look at the market, but it's also something that you can really grow into. Grow into, I mean, figure out. Do homework, you get rewarded for learning more and more about the trade. So just a little background about just interest rates and bond prices. And I won't bore you with this kind of like finance talk, but you probably know, but it's important. Interest rates and bond prices move in the opposite direction. When rates go higher, prices go lower. You don't really need to know why that happens, but I'll give you an example of why that happens. If I decide to buy a 30-year bond, I invest $1,000 and say I get 3% for 30 years. Okay, whoopee, yay. 3% for 30 years, $1,000 face bond. If all of a sudden rates shoot up to 10%, just in like a silly example, I'm still holding that 30-year bond that yields 3%. If rates shoot up 10%, how am I ever going to get out of my bond that only yields 3%? Well, the only way I could possibly do that is the face value, that $1,000, is going to get just smushed. It's going to go down to $200 or $300. So whoever buys my bond, they're going to get 3% for 30 years, but they're also bought it at $200 and it expires at $1,000. So that's where they're going to make up that extra yield or profits. And that's exactly why interest rates and bond prices move in opposite direction. Now we're going to talk about the bond puzzle, how we figure out the bond puzzle. And Bill, this will get into your question. First, what is relative value? When we talk about relative value, and that's how I trade, it's looking at two like components and figuring out which is cheap and which is expensive. And I think a really good analogy is if we have two houses. I live in Chicago. One house is in the middle of Chicago. The other house might be in the northern woods of Wisconsin. 8 hours north, there's really nothing up there but a bunch of summer camps. If you have the exact same house, everything about it's the same, they're both 2,000 square feet, they're both $300,000, which one is a better value? They're exactly the same. When interest rates rise, bond prices go lower. That's the analogy. It's right. It's location, but if you're going to buy a home, you're going to value that home based upon comps in the area, right? You're going to look at the houses all next to that house. You're not going to buy a house in the northern woods of Chicago and price it off New York or price off Montana. It's all relative. So just knowing that we have a house that has 3,000 square feet that's sold for $200,000 to $300,000, we can't tell which is the better value unless we can analyze them based upon comps in that same area. So when I talk about relative value, I want to compare highly correlated products, the 10-year and the 30-year, gold versus silver, maybe gold versus gold, maybe wheat versus wheat. Wheat's traded on 3 different exchanges in the United States. I like to look for opportunities to trade those against one another because I believe if I buy one and sell one, if I can wait until extended levels or wait for those relationships to break down, in my mind, those are very high probability trades. When I trade bonds, I want to look at the relationship between the 2-year and the 5-year, the 5-year and the 10-year, the 10-year and the 30-year. When those relationships break down, to me, that's a good entry point. That's the good time to get in. And the reason I do that is because it's a higher probability play. At least that's the way I see it. And if you think about it like a rubber band. Like a rubber band, if you can pull, it's eventually coming back. And that's how I look at trading correlated products. And that's what we refer to as relative value trading or pair trading. It's kind of the same thing. I'm going to go through an example, and I'm going to use diamonds in the example. Let me also say I don't know anything about diamonds. I just think it's a good example. Okay. The only thing I know about diamonds is how much I paid for an engagement ring. And that was bad value, but I won't tell my wife that. So let's go, right now we have 191 people on here. Let's all go to a flea market, one-day flea market, and all they do is sell diamonds. And these are the prices of the diamonds. They only deal in 4 different kinds of diamonds. We have the 1 carats that are selling for $1,000, the 2 carats are $2,000, the 3 carats are $3,000, and the 4 carats are selling for $4,000. It's a one-day flea market. But because of supply and demand, over the course of the day, these prices are going to change. 5 hours later, the prices look like this. The 1 carats are still trading very actively for $1,000. The 2 carats are up pretty good. They're up trading at $3,000. The 3 carats haven't really moved, but the 4 carats, there's a whole bunch of demand for those 4 carats. If we were all walking together and we had some inventory that we wanted to sell, or we were trading around the flea market, what are some things that we would look at? What are some things that we could do? To me, why did the 4 carats go up so much, but the 1 carats, they didn't move at all? Why did the 4 carats go up so much, but there's no demand for the 3 carats? 2 carats are up a little bit. Maybe the 3 carats are inexpensive. Maybe the 4 carats are expensive and they're going to come back to some kind of better value, like when we walked in, when those 3 carats were 4 and the 4 carats were 6. Exactly, Steve. What we can probably assume, at least I'm going to go with this assumption, the 4 carat is not going to go up 300%, while the 3 carat is going to go down 50%. I think we could also assume that the 2 carat's not going to trade higher than the 3 carat. But if at any time somebody comes in and they need to buy a whole bunch of 2 carat diamonds, maybe for a little bit of time, the 2 carat is actually trading more expensive than the 3 carat. That seems like a broken market, but it's just pure supply and demand. Why can't that happen? Right? It can. But if that does happen, if that 2 carat trades higher, that's going to present the trade. So this is exactly, and it's a little kooky example because, again, I don't know anything about diamonds, but this is really how I look at the yield curve. But instead of looking at diamonds, we're looking at the liquid contracts, the contracts that have all the activity from the mercantile exchange. And we're looking at the ZT, which is going to be the 2-year, the ZF, which is going to be the 5-year, ZN 10, ZB 30-year, and UB Ultra. That's what we're looking at. But instead of just guessing whether they're going to go up or down, we want to trade the relative relationship. Okay? What many don't realize when they trade this stuff, the 30-year future contract, how many years is that bond? I know we have a lot of people who trade the 30-year. How many years is the 30-year bond? The 30-year future contract? Or how many years is the 10-year future contract? Yeah, it's a lot lower, right? It's a lot lower, guys. I love when my clients sneak in there. Mitchell, nice one. So the 30-year is closer to an 18-year. The 10-year is closer to a 7-year. The 5-year is really a 4-year. And the 2-year is a little bit less than a 2-year. Okay, the 30-year is not really a 30-year. But when we're looking at these trades, we're looking at the relationship. And here's a good example. These are all driven by supply and demand, right? There's no wizard that just keeps these in line. There's no wizard that just makes these trade efficiently. They trade based upon supply and demand. So if a hedge fund blows out, or if China comes in and needs to do a really, really massive trade, and they come in and sell a whole bunch of 5-year future contracts, the 5-year future contracts are going to get inexpensive relative to the other names on the yield curve. So what we would do in this circumstance is we would look to, if we wanted to buy, we'd buy the 5-year. If we wanted to sell, you absolutely don't want to sell the 5-year. The 5-year is inexpensive because of supply and demand knocked it out of line. As traders, what we're really doing, the role of the trader is to keep markets efficient. It's not to cross our fingers and place bets on which way the market's going to go. It's to keep the markets efficient. So in this circumstance, the 5-year is very inexpensive relative to its neighbors. Same thing if we look at the 10-year. Maybe the 10-year gets really expensive. Lots of different reasons that can happen. A hedge fund, maybe they blew out. Maybe Patrick called a really big trader and they had a margin call, they're forced to get out of their position. 10-year is going to get really expensive. They have to do that trade. Because they have to do that trade, as traders, we sit around, we wait, we find the market is a little bit out of line. We could sell some 10-year, we can buy some wings. Okay, same thing. I think you guys get it. UB gets expensive. Maybe the 10-year gets expensive. For option traders out there who like to do those butterfly spreads, you can do a butterfly spread. Buy the ZB, sell the 2 wings. What we're trading is the relative relationship of the 30-year against those 2 wings. Bill, great question. When you say value is out of line, how is that measured? Let me go into it a little bit more. I actually think the next slide, Bill, will help you. Let me also say this trade does need to be learned. I really wish that I could teach you this in an hour and send you off running and you're good to go. But just like your business, you're not going to send me off in an hour. It takes time. This trade, for those who commit to learning it, you can do great, but you can't just jump in there. Okay, it's too dangerous. So again, risk is not something we're going to sugarcoat. Let's look at this slide. What I did with this slide is I took the Merck's silly names that they call these guys. So the fight is 5/10s. Fight, FT, 5s, 10s. That's why they call it. Very clever, right? The ZN, ZB, they call that the knob. Clever, cute. So watch the fight and the knob. Okay, the fight is going to be the relationship between 5s and 10s. The knob is 10s and 30s. What we also know, if this is the fight and this is the knob, down here you see this thing says FOB. If we could analyze this spread, 5s against 30s, we can then back into the 2 components of that spread. So the FOB is the 5s 30s spread. But in order to get the 5s 30 spread, we have a fight plus a knob. Fight plus knob equals the FOB. Are you guys following that? What I want to do with this presentation, I really want to show you what's possible. So I know you're not going to completely understand this, but I do want to show you what's really possible. The symbol for the knob is going to be the ZN against the ZB. But what I want you to really see is we can value 5s against 30s, and then we can break down the components of that to see where that real good value is. So now what I'm going to do is I'm going to go more into charts so we can see it more in kind of like real practical life. Mary, you got it. Mary, great question. When you say spread, it's similar to like a Forex, where Forex, you naturally trade spread. You Forex traders, you're like me, we're relative value traders. Okay? Steve, I don't really understand that, like a derivative of a derivative. I think that thinking is making it a little bit more complicated than it is. Okay, so let's go on. We'll keep going. This is not meant for you to complete. I mean, it takes a little bit of time, but I want you to see what's possible and how we look at this. I also want you to see if you're just trading ZN or just trading ZB, you might want to question that a little bit by going through this kind of analysis. So what I have here, this is the 5-10s chart, which is also called the fight. Fight, 5s, 10s, 10s, ZN. It's going to be this part of the curve. This is going to be the knob, which is this part of the curve. These two really should move in a similar way over time. And if you think about that diamond example, this is like 2s, 3s against 3s, 4s. The difference between 2s, 3s and the difference between 3s, 4s in diamonds is just like the difference here between 5-10s and 10s bonds. And what I wanted to do was I wanted to highlight the difference or the trade opportunity. The trade opportunity, and this is just July 25th. This is a chart I made today. July 25th, you can see the fight, which is this portion, was down here and it just broke out, right? The 25th, it just started going higher, rallying. Okay, well, look at the 25th here. The knob didn't break out until the 26th, but the fight already broke out. And that's what I want you to see. Once you start seeing this rally like that, like nobody's business, it's a pretty good chance that 5-10s is rallying, that we're going to see 10s, 30s rally as well. Okay? Hey, Joseph. Yeah, for sure. Hope you're great, man. So that's what we're looking for. We're looking for these little inefficiencies. And you see on the 25th, it rallied really hard. On the 25th, this wasn't ready to rally yet, but those who've been trading this for a while, you can be pretty confident that there's a good chance that this is either going to rally and play catch up, or this will come down, because they can't just go in opposite directions forever, right? The 5-year and the 10-year aren't just going to trade completely different ways for the next 2 years. Probably not even possible. The really neat thing about this trade is that it encourages you to be creative. Again, I keep saying this, it's not easy. I'm not saying this trade is not easy. Trading is not easy. Trading needs to be learned. In my opinion, if you learn something over 2 days, or if you just plug in an indicator and start trading off of it, you're asking for trouble, right? You have to learn stuff. What this is here is how we look at a lot of the markets, and this is a butterfly spread. The butterfly spread is a ZN, the 10-year, which is here, against the neighbors. So it's the 10-year as the belly of the butterfly. The two wings are going to be the 5-year and the 30-year. And so this chart is representing 3 different bond contracts. When the 10-year butterfly is expensive, that's telling us that the 10-year is the most expensive contract relative to the 5-year, relative to the bond contract. When the 10-year butterfly trades up here, if you're looking to do an outright trade, you, in my opinion, you only want to sell the 10-year. You don't want to sell the 5-year. You don't want to sell the bond. When it trades down here, if you want to sell a contract, I wouldn't sell 10-year. That's when you want to sell the 5-year or sell the bond. Okay? And the neat thing about this trade is we can do it throughout the entire yield curve. Look for all these different opportunities. What this is going to be right here, the ZB butterfly, the 30-year butterfly. Now we're getting a little bit advanced, but I want to show you the possibilities. ZB butterfly, 10-year butterfly. Relative strength of a 30-year futures contract up here. Relative strength of a 10-year futures contract up here. Look at the circles. 23rd, the 23rd. The 10-year is inexpensive relative to the 30-year. You see that? Each of these charts has 3 different products in it. Patrick and I have been working together to get these charts all nailed down in Sierra Charts as well. These charts are from Sierra Charts. But you can see right here, the 30-year is very inexpensive relative to the 10-year. You can see it again right here. The 30-year is getting expensive relative to the 10-year. Okay. So Art, good question. Art's saying in simple words, and let me just touch on that. I've been on YouTube, I've been on a lot of videos, and there's a lot of the same stuff out there. What I want to show you is a little bit more, it's a sophisticated trade, but it's a real trade. So I'm walking you through this to show you the possibilities. This does need to be learned. So Art said in simple words, what exactly is the differential you're seeing between the 2 instruments? Let me stop there. The differential is we're charting through a ratio that needs to be learned, the relative value of only the bond contract, of only the ZB. So when this is high, the ZB is expensive relative to the other products on the yield curve. When this is low, the ZB is inexpensive. We can do that with each of the contracts, analyzing it against the yield curve. Again, this is probably going to be a little bit confusing or whatever. I want you to see what's possible. I want you to see how others are trading bonds. If for nothing else, maybe it protects you the next time you just sell a ZB or buy a ZB. Maybe it protects you just letting you see trades are sophisticated. They need to be learned. It's not easy. Okay, it's doable. It takes time. I'm not going to go into your business and start killing it right away. It's just not going to happen. Michael says, what would happen to the bond position if the equities market had a 15% correction? $1 million question, of course. I'll tell you what's going to happen. When the market goes down 15% correction, bonds are going to go higher, right? Most likely going to go higher. That's just how bonds work. What's going to happen? Michael, there's 2 different things that could happen. You can have an environment where yield curves steepen, or you can have an environment where yield curves flatten. What we're doing is we're trading the relative difference. So if there's a kink in the yield curve, we're looking to sell it, but we're buying something for protection. I'm an options trader. An options analogy would be sometimes you sell options, sometimes you buy options, but you're playing for volatility neutral type positions. If I was just trading stock, the way I trade stock is I would have some longs and I would have some shorts, but I would never just only have longs. I would never only have shorts. I'd want a nice balanced position. What we're doing here is we have a nice balanced position on both sides. Okay, Teo, I'll shoot you over Patrick's email. Patrick, Teo's a client, friend, would be someone great to talk to. I know there are a lot of questions coming in as well, so I will get through all the questions. I also just want to say, usually at this point, kind of 40 minutes into it, I find that people are feel 3 different ways. The one way is they're blown away. This is exactly what they've been waiting for. They want to be challenged. Aha, very cool. The other person is, yeah, kind of interesting. I like it. I don't get it, but it seems kind of cool. The third way, how people feel, sometimes they feel kind of like this, okay? Are most of you feeling like this, a little overwhelmed? Maybe you see wow, really cool, but I don't really get it. This one resonates with some of you, yes. What I want to show you is that, especially bonds, there's a better approach. It just is. It's not simple. It can be straightforward. It's not, Chris, it's not a ton of math because I break it all down for you and I show it to you in a very straightforward way. And for those on the beginning of the presentation, most of my bond students end up working with Patrick because of the big advantage that you get from using Infinity Futures. So it's really synergistic having me on here in this relationship because my students benefit going to working with Patrick. It just makes a ton of sense. I don't want to use too many testimonials because Infinity is held to a different standard in the regulatory world, but I can tell you we do have over 100 bond students who are really enjoying the program. Many of them stop trading any other futures except the bond approach. A lot of them are on here. Teo, who I just mentioned, is on here as well. So let me go over, if it would be cool with you guys, let me take 10 minutes or so. I'll tell you exactly how the bond program works, and then I'm more than willing to stay on for as long as you need, answer all the questions. But I think as I go through and explain it, I'm going to cover a lot of your concerns. So here's how it works. The first thing you get is the Bond Bootcamp Foundational Course. How that works is I have two kids. I have an 8-year-old and 10-year-old. They play video games way too much, which makes their daddy talk video game parlance. So video game parlance is level 1 is going to be all about trading outright futures. Just using the butterflies to trade outright futures. Level 2 is going to be spreads. Level 3 is going to be some more advanced yield curve analysis. I also include bond specs, which include the margin and contract info and a couple of other things that I think that you're going to want to see. Over 4 hours of training, this is the foundational course. I found that those who commit to learning this, they love it. They get really into it. They start expecting more from their other trades outside of bonds. They start expecting more than just using an indicator or just using a breakout or head and shoulders. The great thing about this trade is after some time, and it's going to take some time, okay? I want you to know that I really encourage everyone paper trade for a month, 3 weeks or a month. This is good for those who have their head up thinking about the longer term. But this is not something that you jump in and tomorrow or Monday or Tuesday, you want to put on a whole bunch of risk in bonds. You don't want to do that. So you get the Bond Trading Bootcamp. It's a 3-hour on-demand class. That's just the start of it. I loaded it up with a ton of bonuses because I'm so excited to be here with Infinity. What you're also going to get is something that I call Fed Dominator. The 3 hours of the Bond Bootcamp, and then you get another 90 minutes. This is all about butterflies. Really learning the math and how to configure the butterflies. What I also do for all my bond students is every quarter, when the ratios change, I email everybody the bond, the spreads anyway. Patrick and I talk often. If there's any questions, we're kind of bouncing off one another to help you guys. That's our objective. Fed Dominator, it's a 90-minute on-demand video. Start watching it whenever you want. Goes all about the butterflies and the outright trade. So if I put it together, you get the 3-hour foundational course and then the 90-minute Fed Dominator class. Bonuses. Bonuses, I have a 10-page PDF. The 10-page PDF that I designed also comes with an explainer video. The 10-page PDF goes through exactly where all those bonds in the yield curve traded between 2003, when the Fed was raising rates, 2010, when the Fed lowered rates. It goes through those 7 years. It tells you exactly where all the bonds were trading. I find it really gives perspective. So I keep going over that trading is not easy. It's not that it's hard, but you do need to put the time in, just like learning anything new. So I do want to be very upfront with you from the start. This is not something that you want to jump in and risk money right away. Those who do best are going to patiently paper trade, take 3 weeks, take 4 weeks, take longer, ask questions. The clients that have the best results continuously show patience. They're willing to put the work in. they're willing to paper trade. For those who like to say, I don't paper trade, I need skin in the game, be careful. That's not real. That's something that you're creating. If you say you don't like paper trading, paper trade, guys. Use discipline. Try to make it as authentic as you possibly can. There's no reason to lose or risk money while you're learning something that's totally new. This trade will allow you to do that. Put in the time, and it will reward those who put in the work, okay? A couple of more clients just from my bond students who have had great success with me. Stacy, somebody I've been working with for over a year, another client of Patrick's, trades mostly options, and when he trades futures, he trades bond futures. I always like to say at this point, guys, there's pretty much two choices. Try to figure it out on your own, or don't. But I think we do know in trading, if you do nothing, nothing ever changes, okay? For those that notice that this isn't some phony baloney approach, for those who are really interested in learning something new, I created a way for you to learn this, for you to get all your questions answered that I think will put you in the best position to succeed. So here's how it works. For anyone who moves forward with me, I'm also throwing in an extra special bonus for anyone who moves forward while we're live. So you can join the bond program. It's $297. For $297, you can learn a completely unique trade. I have one more bonus to add. You get the Bond Trading Bootcamp, the foundational course. It's actually 3 hours, and the Fed Dominator is 90 minutes. You get that hedge fund tool as well. It's 4.5 hours. If this makes sense to you guys, it's activedaytrader.com/Fed. Here's the one big bonus for anyone who moves forward while we're live. We're also doing a live class at the end of August. On this presentation, it's going to be at least 60 minutes long. I'm going to go over the entire workshop. I'll answer any questions you need. I'm also going to have Patrick there. I'm inviting Patrick so he can work with you on Sierra charts and answer any brokerage questions that you have, okay? But I do keep telling you, it takes a little bit of time. I'd love you to paper trade a little bit longer than you think, because I know that's the best way to make this work. But for your comfort, I also want to say this in front of Patrick, in front of all you guys, in front of the recording. There is a completely no questions asked 30-day return policy. If you get this and it's not what I say it is, if it just doesn't feel right, we're all good. You guys have a completely guaranteed 30-day return policy. If you don't like it, doesn't work for you, it doesn't work for me at all. Okay? activedaytrader.com/Fed. I want to get into all the questions. Let me start with those frequently asked questions because I've been doing this for a little bit, so I have an idea of the questions that pop up. The one thing, again, put it on the screen nice and wide. It's going to be on YouTube, 30-day money back guarantee. If it doesn't work for you, it absolutely doesn't work for me. The other question I get often is, what kind of customer service do you provide? Are you going to help me at all? This is my favorite because I get so many testimonials about my quick reply time. I'll also say it's a little bit funny because for those who work with Patrick, he's the exact same way. And Patrick and I have gone back and forth probably about 40 times. And I don't know, Patrick, what you would say, but I think the average response time for both of us is probably under 5 minutes. Okay? This is something very different than you've been exposed to. It's my job to make sure that it works for you. But again, if it doesn't work for you, send me an email. It's just me here and my wife, Carrie, who handles customer service. No questions asked. You get a money back return within 30 days. The other question I get a lot, what account size? That's going to be a very difficult question to answer, just being straightforward, because obviously I'm not giving advice. I don't know about everyone's individual circumstance. We've had clients come in and do this for as little as $8,000, but everybody is different. I'm always going to suggest paper trade, paper trade, paper trade. Do the exercise, ask me questions. You can reach me, support@activedaytrader.com. I answer all the emails except when they're only dealing with accounts. That's when my wife jumps in there, okay? But paper trade. I think that's my frequently asked questions section. Now I'm gonna jump on, answer whatever questions you guys have. Mary, what credit card? Just if you go to activedaytrader.com/Fed, I think that we take, I don't know, not my wheelhouse, but I think we Visa, American Express, Discover maybe. Mary, you're welcome. Hey Peter, I'm talking. My name is Jonathan Rose. You can just email me at support@activedaytrader. I should have put that on the slide too, which I goofed. I'll throw the chat in the it's activedaytrader.com/Fed too. I'll throw that in the chat. Oh, so Richard, some spread charts are only available in closing price. What kind of charts are bond spreads on? We're going to use formulas, so we're looking at these live. We're looking at real time. So Henry, great question. Henry asks, can you implement these butterflies on Thinkorswim? What many of my clients do is you want to use these spreads on a platform that gives you that exchange traded margin. The butterflies alone are going to be $2,000 or $2,500 a margin with Infinity. They're going to be $15,000 with Thinkorswim. So it's an absolute no-brainer. And what you could always do, Sierra Charts comes with Infinity. Patrick, I hope you don't mind me saying, I know some clients use Thinkorswim to chart and then they trade with Patrick. Just so you know, guys, I said this in the beginning, it's not a coincidence that I'm on here with Infinity, that I'm on here with Patrick. I reached out to him and said, we're straight synergistic. It makes absolute sense. Michael, I love your question. What Michael's asking is live bond class at the end of August. He's a bond student right now. Can he come to class? We had bond classes each of the last 2 months. Everybody in my bond program is always welcome to my classes. So anybody in my bond program now, even if you bought it a year ago, you're not a member, you haven't even touched base with me in 8 months, you're invited to class. Okay? I want you to learn this trade. So Roger, great question. Is this system all day trading or is it swing trading? It's not a system, first of all. This is the correct way, at least in my opinion. Again, with a professional bond firm, 6th employee, we grew to over 200 employees before selling to a major hedge fund in 2010. This is the correct way to value bonds. If you're trading bonds short-term, swing trading, investing, in my opinion, this is the way where you can see which is expensive and which is inexpensive relative to the yield curve. I know that might sound like a foreign language right now. It all comes. I have one client who's a runner. He said he's listened to one of my classes 20 times on his runs, which sounds terribly boring to me, but it's the kind of thing that you learn a little bit more each time. Okay?
Jonathan, I want to touch on one of the questions real quick, just because it's
Chris,
relevant.
You guys are awesome. Another great question. So how the bond program works? How the bond program works is I have 2 pieces of the bond program. One is Bond Bootcamp, which is this. Bond Bootcamp gives you the foundation. Everything you need to understand this trade. It's 4.5 hours. It teaches you how to do the butterflies, everything. Then we do the live class. What I also have, it's the second part of the bond program, is I do have an advanced bond class. The way the advanced bond class works, there's nothing new in advanced bonds that's not in regular bonds. The only thing that's different is there's a private Facebook room. In that private Facebook room, it's all of my advanced bond students who are trading throughout the day. So the advanced bond students, they got a little quicker access to me, but they can all trade together. Right now, there's a waiting list to get in the advanced bonds. You do need to take the bond bootcamp before the advanced bonds. Those are that's the entire bond program. But again, everything that's in this 4.5 hours, there's nothing more in advanced bonds. The only thing additional is you get that community. Basim, there's going to be a recording. I think Infinity will send it out to everybody.
Yes, we do have a recording in
Mitchell, great question. Mitchell's talking about using stops in spreads. So for me, we're going to use P&L stops because you need to, I think the key to trading anything, not just bonds, is position management. And the way that we're going to trade these is you have a certain amount that you're willing to risk. But instead of just putting a stop on and getting out, what I like to do is hedge. I always want to protect myself. So Mitchell, what I'm going to use in a knob trade, the ZNZB, is I'm going to use ZF, ZN to protect that, or ZB, UB to protect that. Those are the stops that I'm going to use, which are going to be closer to hedges rather than stops.
Jonathan, I want to make one comment as well really quickly about the
for sure.
margin. So guys, this is the reason why we're making a big deal about this margin thing. And for those of you who are starting to wonder in your minds, like, okay, is it worth it? Is it worth it to open up another account? And oh God, I don't want to do that. I don't want to learn a whole new charting program and so on. What Jonathan mentioned earlier, we don't take offense to it at all. A lot of our clients who come to us from TradeStation or Thinkorswim, they start off really just by executing with us. A lot of people don't use our charting right off the bat just because they've been using some other company's charts for 10 years and they just don't want the learning curve. That's totally fine. We do make the charts optional. You can still get the benefit of the execution, the Infinity AT Dome, of the discounted margin requirements, even if you're not using our charting package. So we think eventually you probably will want to use our charting, and most of you won't pay for it anyway because the threshold to get it for free is so low. But the reason why we're making such a big deal about the margin requirements is because it's not even close. It's not like the margin is, $10,000 at toss and 9,100 here. We're talking about differences that are in, $15, 20, 40, $50,000. There are some spreads like, Jonathan, like 6 Dow against 5 E-minis. I mean, if you're margining 6 Dow against 5 E-minis, and you're calculating each contract individually, you're looking at a margin requirement of over 50 grand. When the margin requirement really on that trade is $6,300. So the differences are so dramatic that it just becomes a question of efficient use of capital. So if you're a customer of another company, especially one of these companies that sort of does futures on the side, don't be afraid to give us a try. We have helped a lot of people make that transition, and it is, it's a lot easier than you think, especially with, the kind of firm we are where we pick up the phone and talk to people. It's going to be a bit of a different relationship than, what you will expect out of a discount style firm. Just wanted to mention that.
No, that's awesome, Patrick, and I appreciate you jumping in. When I really got introduced to the retail community at the end of 2015, 2016, I always just assumed that everyone did margin the way Infinity did because that's the way I was used to seeing brokerages treat margin. They just treat it like the Merck treats, it's called spam. But what ends up happening is if you don't deal with a firm that specializes in futures, you're going to get, I personally think it's terribly unfair and almost to the point of taking advantage of people by not offering them that advantage. And I don't know the brokerage space very well, but for my advanced students, that's the reason I invited Patrick to an advanced bond presentation, because it benefits, it's a no-brainer. I mean, the simple thing is being long one ZB and short one UB. The difference between Infinity is literally, let me pull up a chart here and I'll show you like a spread, which is a spread that we trade all the time, which will be, this is just the knob here. which just looks like here. And in order to do this trade, if you want to buy it, you're buying 3 and selling 1. This spread on Thinkorswim is probably like $15,000 just put 3 by 1. I'm just $1,100. Yeah. Be a pretty darn close, Patrick. You know better than I do.
Yeah. As of July 11th, that would have been $1,088.
$1,080 versus 15 grand. So what I tell the advanced bond students, it's crippling. It's crazy to use something else as you're learning these different spreads. So that's why there's just tremendous value.
The other thing too
by doing this.
Yeah.
Again,
the other thing, I'm sorry to interrupt you. The other thing too that becomes relevant here, folks, is like there are situations in this type of a trade where your timing is not going to be great. That's just the reality of trading. And there might be a situation where you amongst the group, and if you decide that you're okay with the risk, you might find an opportunity to add one of these flies or add one of these spreads to your existing position. And if your margin requirement on the trade is 15K, then you're gonna run out of money relatively quickly unless you've got an enormous amount of money in your account. So here, you could very easily add to that position with very little impact to your margin, and still be in a relatively safe spot depending on how the size of the account. But if the broker's asking for 15 grand for each one of those spreads, it's just not proper. I mean, that's just all there is to it. So that's why we're making such a big deal about it, is that the differences are not even close.
Patrick, this is probably a question for offline, but how does that work when they charge 15? Are they still paying? They're only paying span, right?
Well, basically, I don't know if it's it doesn't seem like it would be a technology issue with a company, who has unlimited resources, right? Like some of these enormous companies.
Are they taking the spread, or are they taking the overnight lending on that spread?
I don't know. I mean, certainly, they are benefiting from the excess money in the account. I mean, it's also true that with interest rates as low as they are, you could also make the argument that it doesn't really do them that much good. But I just think it has more to do with risk. I think that when you are a company whose risk systems are not centrally based around futures, it's just a lot safer to ask the client for more money, and they don't. What's the value to them in letting people put bigger trades on when they probably don't care that much about the few commissions you're generating? What they care about is having a blowout or losing more money than you've got in the account or something like that. So from their perspective, it's probably just a lot safer, and the client is the one who, has to deal with that.
Right. So they're catering to their core business. So that's why you want to use a specialist. That's
generally our position when it comes to how we compete with firms like those. Yes, exactly.
Right. So even if just kind of to branch away even from treasuries, when I'm trading S&P futures or NASDAQ futures, if I'm long one of those and it starts to go against me, I'm going to look for something that's expensive. And I'm going to be looking for a relative value trade, because if I'm long S&P futures and that trade goes against me, and I can find some nice correlated relationships, and maybe the Russell or the Dow has rallied during the same time, I don't want to get out of my S&Ps. I want to sell the expensive thing and work my way into a spread. And I don't have that flexibility unless I'm working with someone who gives me the benefit of that exchange traded margin. I see a couple of you guys are posting that you signed up. I'm really looking forward to working with you. So Henry, that's awesome. I really encourage, ask questions. Don't feel like you can't ask questions. I love doing this during market hours. I'm sitting in front of my computer all day working with clients. So if you do have any questions, it's absolutely my pleasure to jump in there. Oh, fantastic, Mary, Steve. Yeah, you know what we can also do is I have someone who I've been working with for over a year. I think he's also a client of Patrick's. His name's Steve Williams. I know a lot of people might need a little bit more information or whatever. You could always, if you email me at support@activedaytrader, I can hook you up with Steve, who's been trading with me for over a year. If you want some more color or just have some additional questions, or if you want I guess an unbiased type opinion. So that's also something which I'm more than happy to do. I know there are a lot of people out there who present. A lot of people, you know, have the holy grail. So if that's something that you need to feel more comfortable, I'm completely okay with that. Just going through some questions here. David, that's some good investigative work. So I can see old classes. Hey, Jet, great question too. Jet says, if I sign up, can I see old classes in the past material? So right now, when you sign up immediately, there's 4.5 hours of information. But if you get through all that and you want some additional classes, just send me an email. I mean, I'm more than happy to. I have content. I have hours upon hours upon hours. I think you'll realize too, a lot of this kind of learning, I think it's the kind of learning that you listen once and you take away 10%, 15%. You listen again and you take away 25%, 30%. So every time you listen, like for option traders out there, when you start learning options, maybe it's really intimidating at first, but over time, like, okay, I get it. It's all starting to come together. I think that's the breakthrough people have in bonds. Let me also say that the majority of traders that I run into aren't geniuses. I know many successful traders who barely got out of high school. The challenge of this trade, it's not learning it, it's having the discipline to follow rules and be good at it. Okay, anybody can learn it, whether you can be good about it. Trading comes, you know, temperament, admitting you're wrong, staying within defined rules. That's really the difference maker. But you will get in trouble if you jump in and try to make money, try to trade before you get comfortable. I can't stress that enough. But I'm also going to say that in any trade. I'm just not, I don't just speak that way in bonds. Baby steps, take it slow. If you're in a rush in this game, you're going to get hurt. Take it slow, take advantage of the technology. 10 years ago, we couldn't paper trade on any platform, you know, for pretty much free. Take advantage of that. Ed, I'm chopping up your name, my apologies. The question is, can we learn how to apply this same strategy to other futures? Not so much. But with that being said, I don't think you can really learn any kind of future and just apply it to another future. At least that's the way I see it. The closest future that you could replicate this kind of trade, there's actually two different things. One is going to be European interest rates. It's going to be a little bit more advanced trade. The other where you could kind of do it is in oil, because oil has a yield curve. Oil has a 3-year curve, so you can go out. That kind of resembles the fixed income trade. I think that people spread themselves too thin in trading. I think it's more important to spend some time and learn something well than to be, you know, learn a little bit about everything. Just my personal thoughts. Oh, Eddie, again, no, I appreciate you saying that. Nothing drives me more crazy when I get these emails that people guarantee 100% return in a week, or they haven't lost money in 81 trades. It's just BS. It's not fair. And I talk to my clients on the phone. I've seen too many of them, you know, get really hurt. So right from the start, I'm going to make completely clear that it does take effort. It does take commitment. And I want you paper trading. You're not going to be happy if you come in a week later, if you don't make money, and then judge me on that. It's not fair. That's why I say return it. It's just not going to work out for the relationship. But if you come in and you're willing to put in your part, I'll do whatever I can for you. Jet, I do. You can just email me at support@activedaytrader. Pete, yeah, boom, bobble shots. I mean, it's actually a pretty good trade. You could trade the US yield curve against the European yield curve. So the boond, the bobble, the shots, really cool names. That's just 5, 10s, 30s in Germany. Or is the shocks 2s or 30s? Hey, Art, is the relative strength of the same two bonds? No, no, no. RSI, no, no. Totally different. Relative value trading and relative strength, two totally different things. Scott, so Scott's asking, can these techniques be applied to oil and Canadian dollar as a spread? When you're trading relative value, it all comes down to correlations. And what that means is, let me use stocks as an example. If you're trading two different oil exploration companies that are both based in Texas, that are both US WTI oil, you can probably trade those two against each other. You'd have to look at the correlations, but you can't trade Coca-Cola against an oil company. Like, they don't have anything to do with each other. If you're going to trade Canadian dollar against oil, they do have a correlation. For me, I'd want to see how tight that correlation is. The correlation of the fixed income instruments are darn close to like 80% or 82%. So that's a really strong correlation. Those are going to move together most of the time. When supply and demand comes in, because it's a free market, things may get knocked out of line, but you do need that correlation. Coke and Pepsi, a famous trade was Blockbuster Netflix. Those are really cool trades when you think about taking market share. And for me, those kind of trades just resonate with me a lot more. For one, I like research. I like the hunt. I like spending time finding trades. Once I find trades, that's when I want to get in the market and be confident. But I don't like just trading and then, hopefully it breaks out, or hopefully, some technical reason. That's just not enough for me. So it's just a different approach. I know we skipped a bunch of questions, guys. Does anybody have any question maybe from earlier that wasn't answered? I just want to make sure that we didn't miss anything. Awesome. Okay, cool. Patrick, I think that's all I got, guys. If you guys at any time just email me support@ActiveDayTrader. A pretty quick reply. I'll get back to you before the opening tomorrow. And then if you guys want to take advantage, if you guys are kind of on the fence, it looks cool, but you're done with online education, take me up on that offer to talk to Steve. His name's Steve Williams. Great dude, stay-at-home dad. Patrick knows him as well. Just someone else to talk about.
Excellent. Cool. Well, thank you, man. I really appreciate that. That was excellent. Guys, obviously, this is...
Patrick, I have one more thing, if you don't mind me jumping in here.
Yeah, go ahead.
I sent an email out saying to all my subscribers, I was going to share with you a trick that I use every unemployment. So I'd like to do that if you got a little bit more time.
Yeah, go ahead.
Let me show you here. So what I like to do in any of these kind of unemployments, just get my charts here. Okay. So here's just a 5-year future chart. And let me put it on a shorter term chart. And I do this often. Oh, okay. So give me a second here.
If you want me to take the screen, Jonathan, I can do it. Those are all sort of linked to each other, That's why it's not letting me change the time frames. Yeah, that's fine. Hang on.
Take the screen. So what I like to do, and I'll explain it, and we'll do it on Patrick's screen.
Hang on just a second.
Right now, relative value, the 5-year future contract, in my opinion, is by far the most expensive contract.
Okay, so let's do this here. Hang on just a minute.
So I'll just keep yapping. I personally believe that rates are inevitably going higher. So what I like to do is whenever the 5-year future contract or the 10-year contract goes higher, I like to sell it and hold a core short position. What I like to do on unemployment, right now the 5-year future contract is expensive relative to the rest of the yield curve. I like to work limit orders, 20 ticks, 30 ticks, even 40 ticks higher in the market. And I just like to work resting orders, because what happens is right before unemployment, everybody takes all their orders out of the order book, right? Nobody wants to trade right when the order's coming out. But if you have a level, which I have, which I'm comfortable selling, if the market trades up there, you can leave in a limit order. So what I like to do, and Patrick's got it higher. So right now it's 118.
Yeah, here's a 5 minute this is a 5 minute chart right now on September 5-year.
So what I like to do is leaving a limit order at like 118.25, 119.05, 119.15. So if you get that little spike up because there's no liquidity and there's no orders in the book, and some silly goose goes and does a market order right there, the only limit order that's in the book is me or you. So oftentimes we get flyers up there where they go, they trade, it comes right back down because you're the only person willing to put an order in the book.
Right.
I do that every unemployment pretty much. I always kind of share it with my membership of what I think is the most expensive, just like Patrick drew that line. So Patrick, does that make sense? Because everybody takes their orders out of the book.
Yeah, definitely. I mean, this is why the market, I mean, that's what creates that volatility, is the lack of participation. So, if you feel, convicted about the market, either reverting back to its mean that way, and you're okay with, with the idea that, there's always a chance it spikes through and keeps ripping higher. But if you
100%,
right, but
100%.
But if you think that's going to revert back, then yeah, I mean, you could work an order up there, and certainly, certainly we have clients who do that. I mean, many of our clients do trade that way.
So just so you know, I don't want to do the same thing on the buying side, because right now the 5-year future contract is very expensive, in my opinion, relative to the rest of the yield curve. So I'm not just going to play for a mean reversion from either side. So I have no interest of buying 5-year future contracts, because my view is that rates are inevitably going higher. But for whatever reason, if they do spike because of that illiquidity, I have a level such as that 118.25 that I'm extremely comfortable getting short.
Right.
So that's what I like
picking up a bargain, Is that,
yeah, it's a flyer. If you don't get filled, no harm, no foul. If you do get filled, I think you're going to like that fill.
Right. Cool.
So Manisha, how do you know if the 5, 10s, 30s is expensive? That's exactly what I teach. It takes a little bit of time. You'll get it, but that's exactly what we teach going through the program. Awesome. Hey, Patrick, thanks a lot, buddy. This was great. Thank you, everybody, for all your questions, and a bunch of new clients, guys. I look forward to working with you. And again, feel free to email me, whenever you want with your questions. Oops. Richard, my pleasure. Thank you.
Great, guys. Well, thank you, Jonathan. I appreciate the time. Everybody, thanks for sticking around. Obviously, as I said at the beginning, a bit of an abstract concept for the regular people out there like myself, but Jonathan does a really good job explaining this. We obviously appreciate that. He's got a good resource available for people. He's not asking for an arm and a leg for it, which is something we appreciate. We want our clients to keep their money in their trading accounts, obviously, just like where you want it to be. So that's something that we appreciate, and we appreciate the value he brings. So thank you again for coming to the event, Jonathan. Cheers, man. Thank you again for a great event. Much appreciated.
Thank
folks,
you.
Yeah, you're welcome. You guys want to try the program out, or if you want to try some of these spread chart files, we've got them here. You're welcome to take a look at it. It's a nice way to just kick the tires, so to speak, without having to pay any money or open an account with us or anything like that. Obviously, looking at these charts on your own without some instruction is going to probably leave you at a bit of a loss, but at least you can get the feel for the mechanics, and that's something we're happy to provide to you without asking for a penny. All right. Thank you, guys. Appreciate it. Everybody have a great night. I'm going to read through some risk stuff one more time, and then we'll close the room. We should have everything up on YouTube within a day or so. All right. Cheers, everybody. Thank you again. All right, folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you. In light of your circumstances, knowledge, and financial resources, you may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, everybody, thank you so much for coming. See you next time.